Are we at an inflection point in the housing market right now? Well, if you're a real estate investor, whether you're active or passive, you're relatively interested in multifamily investing. Well, the Gray Report is the YouTube show and podcast that's designed especially for you, breaking down all the latest research reports, data, articles, and throwing out some original opinions, all related to the multifamily industry, real estate, and the economy. So whether you are, again, new to investing, you are seasoned, a lot of the viewers and listeners are actually, industry insiders. Well, again, this is perfect for you, and you're going to be really interested in the reports that we have today. We're going to be going over the latest from the Harvard Joint Center for Housing Studies, putting out their annual report, which is very critical every year when it comes out. Another report from CBRE, MSCI, Rent Cafe, Marcus and Millichap, and Apartment List. A lot of interesting reports. You want to stick around for the whole episode. Make sure you like, subscribe, leave a comment. Let's get into it. All right, welcome back to the Gray Report. Matt Bosnagle, Director of Communications and Marketing here at Gray Capital, joins us once again. Matt, another really great report, really interesting stuff. Yeah. A lot of really good new data that's come out. And as the Harvard Joint Center for Housing Studies, puts it, we're at an inflection point. And I think we know that from the data. And certainly anecdotally, we were talking about a lot of anecdotes, one from our experience in the multifamily market, but also just hearing things from, real estate brokers, agents, things that are going on in the single family home market. These interest rates have really changed the game, and then figuring out where are we in the world with inflation? Are we at peak inflation? Are we just getting started?
Yeah.
The world looks a lot different than it did certainly a month ago, 2 months ago. Yeah. And, are we kind of at this point?
That's one of the things that I was thinking of as I read all of these reports is the question of what the inflection point could be if we're at it. How sharp would it be? Yeah. And the quality of it, because we could be inflecting on some things and not others.
Yep.
And also
quality. Yeah.
The size of the housing crisis. And this is the other real big takeaway is, I don't want to say uninflectable, but housing demand in general, you could cut it down at its knees and it would still tower over everything.
What are you talking about, man? Everyone says there's a real estate bubble.
No, well, I'll get into this because there's one specific report here. It was a brief actually where the size of it is like you can't even budget. It is just a juggernaut. Now, and I'm not trying to. This isn't hubris, because I do think that we are reflecting. There is going to be some movement, and it could be a slight downturn, but I don't expect anything sharp happening. There's not going to be something where you blink and you'll miss it. Like I've said before, we will see this coming, and it's not because of even really like the nature of commercial real estate. It's the nature of the housing market. It is so big that it's going to take a huge force to move it, and to even move it a little bit has taken a lot of effort from the Federal Reserve and other people.
And so the crisis, it's not a demand issue. It's an affordability issue at the end of the day, because there's still an incredible amount of demand for housing. I mean, again, it's kind of an essential thing that everybody needs. Everybody needs a place to live, but what can you afford? And there's a lot of people who were, hoping to buy a home that they're just priced out. It's not an option, but they still need a place to live. But that demand isn't going away anytime soon. So I think it's a good point. Now prices are so high and they've moved so quickly that it leaves a lot of people wondering, like, well, maybe we need some kind of correction just to be relative to what is affordable. We're not really talking about the fundamentals of housing, pure and simple. It's really kind of a financing and a financial issue that's leading to this inaffordability, the high price, and we can. A lot of the blame probably lands, at the Federal Reserve, because really inflating the bubble with incredibly low interest rates, buying an incredible amount of mortgage-backed securities, and then kind of cutting that off. So inflating the price significantly, but now making it incredibly unaffordable, and purposely trying to destroy demand to bring housing kind of
swinging back on the other end. I think that in that sense, yes, it is. It's disappointing. It's unfortunate, but it could. This is not the we're not going to see an implosion, I don't think. And it's nice to know that, maybe it is just, if it's just high prices, that's something that you can kind of deal with.
Yeah.
But if it was something that was fundamentally wrong, like a bubble, where you realize this bubble's hollow, there's nothing in there. Well, no. It is full right now.
Yeah. I had breakfast with somebody this morning. He was investing kind of just before the great financial crisis, and he was talking about how he was able to get some of those, kind of no income verification loans. And he's like, it ended up working out really well for me because I bought some good real estate and they were rentals, and the rentals, relatively did well because you had demand for rentals, even during the recession. But he was like, there's no way. He's like, they shouldn't have lent to me. And so, that was a problem that, just we don't have going on today.
Yeah.
And there's so much equity built up in homes. That doesn't mean that that won't feel painful for someone who's trying to secure housing right now, whether it's in the rental market or on the single family home market. Because what we saw happening in the single family home market over the last couple of years, now that's happening in the rental market. Even, we've talked about bidding wars for certain apartments in the past. I saw some reports again this week talking about new bidding wars just for, just an apartment unit. So it's really driving up the price. And and there's some solutions on reports that we're going to talk about today of, we just need the new supply, but that doesn't get built overnight.
Yeah. I think that a lot of this too, and what I'm hoping is a lot of, this talk about the a bubble, a real estate bubble, and linking recession to the housing market. That's the past drama of like the late 2000s, and you can't, history does repeat itself. Maybe it rhymes, but like I've been looking, where are the cracks?
Well, we looked back to recessions on, I think, the last Gray Report, and we went through and looked at the last 4 or 5 recessions, and only one housing had really any meaningful. Well,
that's a good
2008, financial crisis, the housing crisis that happened.
Yeah.
There was a major drop, but the preceding recessions, the real estate, single family housing and multifamily just kind of flattened off, and there wasn't really much meaningful decline at all. And then they continued to rise after that. So first, Matt, what's going on? How's your week, man?
Been pretty good. I enjoyed going up to a new property with you.
Yeah, we were up at Club Meridian up in Michigan, just outside of Lansing. That was a good time. It was a it's just at the distance where we can make it up there and do a one-day trip. But, we can only stay so long. Obviously, Matt Baxter, stayed there for, an extra couple days, getting things moving. But, I think property's in good shape. There's plenty of work to do. But, I think we've got a great team up there, and it's nice to see, a lot of hard work from the entire team kind of all come to a head. And hey, we've closed this property, and
it is nice. One of my favorite moments is, we work so hard building a deal and getting investors and all this kind of stuff, and just to see it real and go this, it's a reward in itself.
Yeah,
so.
And it's also always good or it's a great feeling that happens most of the time. It doesn't have to necessarily, but as you put a deal under contract and you get closer and closer and closer to closing, when you're doing due diligence, you're really able to take the time to really get into the nooks and crannies of a deal. You're going through hundreds, not thousands of documents or pages of documents, from inspections and going through their financials, and you're taking a fine-tooth comb going over these properties from a physical standpoint, an economic standpoint, doing full audits of the financials and the leases. And when it keeps getting better, it's like what we keep finding is good stuff. It's confirming what we thought, or maybe it's even better than we thought. And then what's really been the case over the last really 2 years, you didn't see this as much kind of pre-2020, really kind of mid-2020, but how much rent growth occurs and how much revenue increases from the time that you submit that letter of intent to you go under contract, you sign your purchase agreement, and then you're checking the rent roll once a week or every other week, and you're seeing these steady increases, and you thought that you're going to be starting with X amount of gross potential rent, but it's actually quite a bit higher. And then for this particular transaction, we were able to get some pretty good loan terms, but it was pretty volatile because with the whole interest rate situation, and all of a sudden the 10-year treasury spiked, and we had loan proceeds that were significantly reduced, and we had to renegotiate the purchase price. And then then there was a window where the 10-year treasury dropped, and we were able to rate lock at that time. And so at the end of the day, we're like, this deal's gotten even better than what we thought. But it often happens, doesn't always happen, but it makes you feel good. That like, we've made a good decision here, and we've removed a lot of risk, because there was a lot of risk, during the transaction of, mostly revolving interest rates and securing the financing. But once that was done, it's like, we've removed interest rate risk from the deal for 10 years.
Yeah.
It's set up for, a really great long-term hold. But yeah, it's not done until it's closed. And then the real actual work starts then.
Yeah. So the real actual work, again, it's like, this is hammering boards and the physical labor, but it's like, it's good hardy work.
Oh yeah. There's a lot that goes into doing these deals, finding them and putting them together.
Yep.
All right, well, let's dive right into the Harvard Joint Center for Housing Studies. This is their annual report. This is a highly anticipated report, Matt. A lot of good information. It always gets quoted in a lot of other sources. There will probably be dozens of articles that are just based on a couple tidbits of facts of this report. Now, if you're subscribed to the Gray Capital or the Gray Report newsletter, you're going to get sent this directly to your inbox. And again, that's one of the great things about being signed up on the newsletter. It's not a bunch of fluff and marketing that's sent to you, although occasionally it'll be like, hey, we've got an opportunity. But it's mostly like, this is all the information you need to know. It's packed full. And this is just kind of really, the podcast is a brief example of the type of research and information you receive signed up for the newsletter. You can find that at graycapitalllc.com/newsletter. So anyway, the state of the nation's housing 2022. Matt, just bring us right in. What are the takeaways?
So the report begins with what we were talking about, the statement that after a record-shattering year in 2021, the housing market is at an inflection point. Like I noted earlier, there's a little bit of nuance here that's not quite captured by saying that 2021 had a hot housing market and this time's different. You'd think, an inflection point after a great year for the housing market, that means we're inflecting downwards. I don't think that's necessarily the case. I do think that things are going to change. Yep. And it's just, this is a point where I think people need to open their eyes and really, and sometimes it's good to look at the forest. Sometimes you need to take a look at the trees because maybe that's where you see the wind changing.
Ooh,
I know.
Nice. That's good.
I gave myself
that's
goosebumps.
Good. Well, I think it's a good point because real estate's such a slow-moving industry, and especially on the single-family home side, they're not tracking the 10-year Treasury. They're not necessarily tracking mortgage rates unless they're in the process and their lenders like, hey, rates have gone up or gone down. You need to do something. But there's a disconnect of what they think they're going to be able to get and where prices are, and then the transaction process. It takes so long. So it's just such a slow-moving industry for price discovery to occur. Yeah. But I think that we're just starting to see that change again, anecdotally. But I mean, certainly just from our own. And this is on the multifamily side, but it's like deals are not penciling, and they don't work from our standpoint, at least, at the current prices that sellers are asking. And so there's a big difference between the bid and the ask. That spread is just too wide for a lot of groups right now. So we're just starting to see that. Yeah,
and and taking a look at these kind of immediate change. If we're at a transition moment, you want to make your assumptions, and you want those trend lines to be accurate. Because if you're going up and things start going down, which happens when you're at the peak of something, then you could really, you could really shoot yourself in the foot.
Last year, 2021, you could say, and we said, because we saw where things were going, and we had the data at the time of, we're going to see 20%, 15 to 20% rent growth over the next 3 years. Okay, that's extreme, but we're pretty well confident in that. But now in 2022, we've already absorbed, 15. We've already mostly absorbed that. And so now to say we're going to get another 20% or another 15 or another 10, is that possible? Sure, anything's possible. And I guess, relative to, just looking at this chart real quick, you can see, and if you're listening to the podcast, we're looking at a graph of apartment rents and home prices. I mean, the home prices have risen significantly more than rents, but rents have risen quite a bit as well. And, wages, while they are rising, in some sectors they're kind of rising with rents, but you can only raise rents so much. And there's so much inflation throughout the economy between gas and energy and food. People can only afford to pay so much, and we've got to be kind of approaching that limit. So someone could say, hey, we're going to get another 20% rent growth. but that's a lot of speculation. To your point, if that's the trend line that you're using, and we're just going to continue to get 20%, maybe you can justify that. But I mean, there's a lot of risk, and it's rolling the dice. Where I'm not for me.
And I think that it's not always true that you have to really look at the minutia and where the winds are blowing every day, because that can get distracting. But when if you keep your eyes open and notice, okay, things seem to be changing, this is time to really notice the small things.
So Matt, I want to ask you, so what is the difference, like sourcing on this material that the Harvard's using, that like of some of our common sources, like the Yardies, like the Real Pages, the Colliers, Marks, the kind of the brokerage firms, those kind of industry groups. What's kind of the difference? Is there a difference in methodology, or how are they?
I think you mentioned it too, and I think one of the things that that makes this an interesting and I think worthwhile contribution to some of the reports that we're studying every week is that the audience is different. You said, a lot of people use this. Policymakers use this. An MSNBC host might use this.
Oh yeah, they will.
It's a wide swath, and also, I talked a lot about like the nuance to the inflection point. Well, there's different perspectives of an inflection point. One person's rent growth is another person's housing affordability crisis. And that's one of the things that really this study touches on more than anything, is the experience of renters. And like you mentioned, if you ignore that, that there's some real resistance from the experience of an everyday renter, then you'll be blind. That's a bad business decision for you. We need to be aware of the struggles that people are going through, because it's human, first of all, but also it's good business sense. They're not, it's just not going to make sense to overcharge people. They're not going to come. So I think that this is valuable because it gives a good state of affairs of where things are headed from the perspective of renters, as well as the perspective of kind of producers and stuff.
Yeah, but much more neutral opinion, I would say, not just aiming towards, which a lot of those sources that we receive are really aimed at buyers and investors.
Yes, exactly.
And being like, the rents are up, that's a good thing. And you should buy more apartments. Where this is looking at it again, like, hey, we don't have a dog in the fight. Let's just look at the actual housing market, and through a lens really more from the consumer, the renter, the buyer, but really kind of from any standpoint, anyone that's in the market related or interested in housing.
Yeah, and I like this too. It is not that deep in the weeds. It's a very not conversational, but it's like plain language. You can really grasp it. It's not intimidating by any means. Just coming back to the experience of renters, the report's opening paragraph, where it kind of set the tone. They also note that for lower income households and households of color, the pressure of high housing costs is unlikely to relent. This is a significant inflection point. I think the state of the economy, and you've really built this up, it's a lot more shaky than it used to be. And lower income households, and I think renters in general maybe, are a little bit more sensitive and vulnerable to changes to employment, not only just employment, but in terms of budgets. Inflation, as this report notes, has impacted the expenses of lower income households more powerfully than those with higher incomes. In 2021, maybe more lower income renters could afford to pay rent. But now, with gas, food, utilities, and more going up faster than wages this year, the inflection point here could be the moment that many of them can't keep up with rent increases in the same way that higher income renters can. And we have seen this in the lower rent growth of Class C properties. And it's, I'm not sure if, there could be this K-shaped recovery that people are talking about. But it's hard to believe that won't kind of spread a little bit to the higher income renters if this recession
at some point
really digs in.
Yeah, no, I mean, you're seeing, as you said, a lot of growth, kind of the higher end segment, just people have the cash, and maybe they were going to buy a single family home, and now they're not. And so, but they've got that extra savings ready to go. But I mean, think about, in 2020, 2021, I mean, what was going on? So we had stimulus payments for one. We had an eviction moratorium. Gasoline was, a barrel of oil, was futures were negative for a couple days or a week. So so gas was cheap. You weren't driving around also. So and then there's just money sloshing around in the system. Just free helicopter money going everywhere. PPP loans, all of it. none of that, that's all gone. That's all gone. The Fed isn't, buying mortgage-backed securities and treasuries. They're letting them expire right now, or they're selling them. So it's a completely indifferent environment. Yep. And, why would we expect the incredible growth that was fueled from all I just mentioned last year? Why would that, continue at the same at the same clip?
That's a good point. Looking, looking at, the kind of shaky conditions of now to kind of see where things are going, but also realizing, okay, take away all that good stuff that was temporary for 2021. Where will we be?
Yeah. What is the real economy?
Yeah.
What's the real condition of everyone? And so that's what I think we're all kind of figuring out right now.
Speaking of kind of the strength of the housing market and the strength of the economy in 2021, this report notes that since the start of the pandemic, housing construction is at a new high. Household growth has remained strong despite the pandemic. Home ownership is actually up. They've added 2.2 million homes since March of 2020, but I think it is a little bit significant that older individual home ownership rates have risen faster than younger cohorts. Even so, the fact that there are, we're talking about a home housing affordability crisis, but more homes were bought than before by 2.2 million. That seems like a lot. It's
just not enough homes to go around.
Still not enough homes to go around. And even though housing construction is at a new high, and housing construction, it's not like it varies a lot. I think sometimes it's high and sometimes it's low, but the fact, it's high now, and we're working very hard. And I want to get to this in the next report. But we're nowhere near addressing the amount of demand that's going into the housing market.
Do they say? Because I know that often this report, the Harvard's Joint Center for Housing Studies report, often lists the number of housing units that we are short.
No. The CBRE does.
Oh, CBRE does. Okay, we'll get to that later. Because oftentimes, or at least in the past, they have included that. But I mean, from the numbers that I've seen, we're anywhere between kind of 2 and 7 million housing units, kind of short, depending on who you ask.
Oh, wow. Okay, so the CBRE was specifically limited to the apartment market. Yeah. But I would definitely agree. I've heard similar figures. I remember talking about this last year and the year before. Yeah. We'd have to build and build and build to get out of this, and we can't do it. We're trying. Even though housing construction is at a new high, talk about hard limits. I think that the reason why they can't build, they just can't buy things or can't get the labor.
Yeah, can't get the labor, can't get the materials. Everything just takes longer. I mean, we saw how expensive it is to build just because, from regulations and zoning and building codes. But, still some of these government offices, they're working from home, or the office isn't open. It's open one day a week. And it's a lot of work to get something approved and moving forward.
So it's funny. I was listening to a podcast where a researcher from the Joint Center for Housing Studies was talking about, what is it going to take? And the first thing she mentioned was regulations. And she said, if there's a regulation that says you need 4 parking lots for every apartment unit, and that's going to be a drag on apartment developers. Maybe they're not going to be as incentivized to build new ones. So they're onto it. People know. And I think I keep coming back to the Biden White House plan to get new affordable housing. And one of the things that they're aware of is they got to reduce regulation. They're not talking about rent control. They're talking about building more supply.
And the problem is that, collectively, as a nation or even as a state, sometimes even as a city, you can say, okay, this is the problem. We need to, loosen up regulations, because we need housing. But it's almost always a very local, hyper-local decision of, a zoning board or a town council, and it's their buy-in, and it's, they want all those, they're the ones that want to nitpick.
Yeah.
And they're like, no, we want to use a different facade. And I know they're only, 2 units, per 2-unit apartments, but we want you to have 3 parking spots or 4 parking spots per unit. I know you wanted to build 200 units, but we're only going to let you build 140 units. And all of a sudden, the project doesn't make sense and it doesn't get built, or it's way more expensive, and so the rents have to be higher.
There was a plan earlier for affordable housing in Indianapolis.
Yeah.
That was just scrapped. I think because of local opposition. Maybe they didn't read that report that said affordable housing doesn't have an impact, or perhaps even raises local home values.
Well, unfortunately, they are not subscribers to the Gray Report. So if they can hop on over to graycapitalllc.com/newsletter.
I feel bad for them.
Sign up. I know. Maybe we'll send them an email or something.
Yeah.
So where do we go from here, Matt?
Yeah,
what are the conclusions?
I am got some momentum. I'd love to talk about the CBR report.
And so I recommend, this is a 50-page document. This Harvard Joint Center for Housing Studies. I highly recommend, if you are interested in the housing market, this is going to provide you with a lot of information to kind of see kind of where we are and what the situation is. This could be a whole episode, right here.
Yeah.
But we've got, as you said, Matt, we've got a lot to get through. All right, let's get to the CBRE report. Build, baby, build to solve the housing crisis. Can we do it?
So I'm glad that headline hooked me, because this short research note from CBRE is really worth reading for their analysis of how many housing units are currently needed to meet demand. This is one aspect of the housing market that's not facing an inflection point. We need more apartments today. We needed them last year, and we'll need them next year. Even with 2022 completions projected to be about 1.5 times the amount as last year, that new supply coming into the market is offset by an increase in apartment demand that's just as dramatic. Wow. We may build a little more than 400,000 multifamily units this year, and that's great. That's a lot more than we've built in this chart since 2000. Even then, the need for these units is around 900,000. The shortfall, as CBRE calculates it, is 521,000 units. That's how many units we need to bring vacancy close to the 20-year average of 5.1%. And that's more than a year's worth of building. If we see more people come into the apartment market because of the barriers for first-time home buyers, that shortfall could increase even more.
Yeah, and we were setting records, kind of in the 300,000 units delivered. It's not getting us to the 500, and there's more demand every year.
Yeah, and one of the most striking things, and I need your perspective on this,
okay,
because the vacancy numbers in this graph are strikingly low. The trend line is barreling down to 2% vacancy. The graph doesn't go back any earlier than 2000, but still, we are currently facing an amount of apartment demand that's twice as strong as anything we've seen in the 2 decades before the pandemic. Again, 2% vacancy seems pretty dang low, even for today's standards.
Yeah.
The label on the graph says vacancy RHA, and I really want to know what RHA means. I tried Googling it. I kept coming up with places like Rochester Housing Authority or Reno Housing Authority.
Matt, you're the expert. You don't tell everybody you don't know what it means.
I've emailed the author of this brief for additional information, and I hope to hear from him shortly. I am nothing if not a dogged reporter to chase down what this needs. But the reason why I'm interested in what that RHA means is because 2% vacancy seems so low that
But I mean, on our board over there, of our asset management board, in the office. Look at our current occupancy across the portfolio right now. Yeah. I mean, it's like 98, 99,
okay,
100,
right.
98. Now we've got like one property that we're doing like a big renovation on, we've created vacancy to renovate the units over a short period of time down in Bloomington. That's the only one that's below 90, but that was the plan. But everything else is 96 to 100.
Man, see, the apartment list has it at like 5-ish, around 5, and I don't know what if this is a specific measurement or not.
98 for the nation, I think, is a little high. I'd put it around. Again, this is just reading all the reports, anecdotes. I put it right kind of like 90, 96-ish, 96 and a half.
Yeah,
which kind of the long-term average is like 94 to 95. But then the biggest difference is, markets like Indianapolis, some in the Midwest that have historically been kind of in like the 93% occupancy range, 7% vacancy. That's all increased now to where we're all in like the 96s, 97s.
Okay.
So maybe there are some markets that are historically kind of in the 95 range. Maybe they are all 98.
Yeah. So kind of getting back to the title of the article, it says build baby build is encouraging, and I think we need to be encouraging multifamily developers. But for the size of this problem, we're not going to be able to build out of it in a year. Maybe 5 consecutive years of very active apartment construction could get us closer, but anything sooner than that seems like moving mountains.
Yeah.
One important caveat here is apartment demand. And I think that it's difficult to imagine anything that could bring things back to the old normal. Vacancy could go up. Apartment demand could go down for reasons other than an increase in supply. But I think an economic downturn could make household formation go down.
Yeah.
There's a lot of external things that could happen. But even without an external force, it's likely we won't see housing demand this high forever. If I was guided by an impulse to revert to the mean, I'd see housing demand in 2022 as an outlier that slowly cools off for the next 5 years. But the thing is, even with demand cooling off, we still need to build more apartments. Looking at the graph, you can see clearly how the housing crisis of the late 2000s. Now that's the one where they really, that was specifically the housing crisis. Those two in the pandemic, those are the periods with the most dramatic changes in demand. Apartment demand has gone up in the past few years at a way higher rate than it went down in the higher housing crisis. If you had a catastrophe as big as a great housing crisis, that would not even take demand down to a manageable level. That peak year, that 2009, we needed about 300,000 less multifamily units, and vacancy was around 7%. If we suddenly cut demand down by 300,000 today, would still need another 200,000 units to affect demand, to bring it to 5%.
And developers will build. I mean, I think at some point, but it just takes so long. It's not like, I heard this recently. We were talking about commodities and like lumber, and it's like, well, it does grow on trees.
Yeah.
It's like you can make more of it.
That's true.
Maybe it takes a while to plant. So there's some time in it, but like it literally you get more of it. But like in housing, you can build more of it. You got to grow the trees. You got to get the oil to make all the plastic and all the the vinyl and the flooring and everything else that petroleum goes into in a house. But it doesn't happen overnight, but eventually we'll get there. And I mean, there was a shift between, call it, 2010 to now. I mean, it flipped. There's no reason why in 10 years we couldn't see a glut of housing at some point, but it's certainly not in the foreseeable future. Yeah. And pointing to like, we're going to see a crash now or 23 or 24. I think we have to at least look out into 2026, 27 to see that happening. Now, and this is a little bit off topic to this graph, but I think in this warrants entire separate discussion. But there's also there's going to be a period where how these properties were financed, where they were on short term bridge loans, with this floating debt that's getting more and more expensive, and they're going to be coming due. And could they be coming due kind of at the same time that we're seeing a lot of supply come on the market. And so people are going to have to be forced to make a decision. So not only is a lot of new inventory coming up, but people are going to be selling things all at the same time.
Okay.
That's at least, that's a little ways out. And the issue with the refinancing on the short-term bridge loan, that's probably going to happen before a lot of the new supply comes online. But those are the things to be looking out for. I mean, and I personally see it as like a major buying opportunity.
Yeah. But one of Matt Baxter, he's like, I get working here and being in the multifamily industry. I'm looking at all the apartments and I'm like, when's that loan due?
Oh yeah. No, we search all the time. All right, when are these loans expiring? We got to do something. Yeah. You got to refinance. You got to sell. You got to make a decision. Yeah. And if you can get ahead of that, and with rates where they are now, there's a lot of people who are going to say, okay, maybe prices have declined a little bit, maybe cap rates have expanded a little bit, but I'm still, the value's increased so much over the last couple of years, it just makes sense to sell it rather than refinance right now. So I think we're going to see a lot of that. And again, I think that there's going to be some owners that are going to have to make a decision, and it could be a great buying opportunity.
That's what
not yet, but soon.
Yeah, when the market moves, there's opportunity. Even if it moves down, there's still opportunity.
And like the cracks are pretty small right now, but I mean, again, like talking about the single family home market, it's like the switch has been flipped. Yeah, just one day. Now that is leading to growth in multifamily and increased demand for rentals, but the switch can be flipped, for multifamily as well, and we'll see when that happens.
Yep.
All right, MSCI or everything on CBR. Any other big highlights?
No, that was really it. I'll keep everyone updated on what RHA means. Maybe someone can share their information in the comments.
Drop it in the comments. Okay, MSCI, U.S. commercial property price growth held steady in May, so we're still afloat.
Yeah, another brief item. This one's from Morgan Stanley Capital International. Looks at how the prices of real estate assets, the prices themselves. We covered this, I think, last month. And this data is for the month of May. It's not rent growth. It's actually the prices, which I like, and I don't normally see that as a whole.
Yeah, it's hard to get the data. It's not always. It's pretty opaque.
And similar to the month prior, industrial properties are the leaders for May, growing at an average of 28.6 year over year, and multifamily properties are at a close second with 23.3% price growth year over year. Another very notable note here, if you take a look at the price growth for commercial real estate as a whole, and there's a chart that you can kind of expand down there, there's a noticeable plateau of stability for the RCA CPPI, All Property Index. It dipped a little. It seemed like maybe at the beginning of the year, but we are at about 3 months of stable prices. It doesn't look like cooling or heating up. It's just a clear moment where growth is stable. We're still growing, but no faster or slower than average.
And so in that I guess that plateauing and that slight decline, I mean that's that's almost all related to suburban office and retail.
Yeah, that it is. It's very encouraging that the office market in the central business districts are recovering at the rate that they are now. It does seem like retail is dipping slightly, but not as dramatically as suburban offices.
But I mean, even in the apartment sector, I mean, that looks like a little bit of a plateau.
Oh yeah, that's I think the story of what we've been covering for the past few weeks and few months really is like, yeah, we're elevated, we're high, we're not cooling off. This is just pretty stable, elevated growth.
Because with rates, I mean, rents are growing, but you can't justify paying incredibly low cap rates when you are paying significantly higher interest rates. People are buying 2 and 3 caps.
Yeah.
Okay, well, if your interest rate was 2%, 3%, you could make sense of that. But if your interest rate is 5.5%, 6%, 7%, doesn't make any sense. And so the price has to come down. Now, like the values are relatively stable because of the rent growth, but you can't speculate on just, cap rate compression and rent growth just continuing forever.
Which is nice, that we don't. I was worried, even as the market kept heating up, I'm looking for, that just eliminates a little bit of buying opportunity and eliminates the ability to predict the future. Even if things keep growing up and up, there was a point late in the late summer and going into like October of 2021 where we were like, when is it going to stop?
Yeah, it was, but we saw the growth. We saw it was going to continue because the market rents have moved and the rates were still low, and we're like, okay, we think we thought that it still had some legs. We didn't know how long. We're like, maybe another year. Who knows? Nobody knows after that. And that ended up so far. That's been the case. Yep. But now it's like it's not going to be another year. Who knows? The rent growth probably going to be moderate. Inflation's high. We're probably going to see some growth, but it's not going to be crazy. But the price growth, again, the demand has been destroyed to an extent just because the financials and the returns aren't there. It doesn't make sense. Yeah. And so we're gonna see what really happens, and but then how much growth is it an earnings story as you could say, like tracking the stock market in general this is very much coincides with the shift to value investing and looking for cash flow, which apartments are. That's exactly what apartments do. But really getting back to the fundamentals and buying on value, and and no longer speculating on buying on pro forma or basing your purchase price on a cap rate based on the trailing 3-month or 1-month financials, which is going to be the most favorable to the seller because rents are higher last month than they were a year ago, you know. But now you were coming back to actually getting a purchase price based on the actual last 12 months of financials and a reasonable cap rate. So we're kind of getting back to normal. But you know, like, and you've heard me tell the team, and that, you know, we want to buy deals. We make money when we buy a deal. But like the last thing we want to do is buy like a bad deal. You know, one bad deal, like the game's over. One, you know, we're putting our own money into it, but like we want to have as close to a, you know, perfect track record as possible. We want to have each deal be, you know, as close to a home run as possible. It's minimum has to be just a great deal. And when we refuse to over speculate just to get a deal across, just to do a deal. I mean, I told, again, Jay, you know, the first person we brought on, like the first thing I told him is like, we're never going to do a deal just to do a deal. And right now, the way we're looking at deals, the way we're underwriting them, we can't do any of these deals. And so it may be a couple month period, it could be 6 months, it could be a year before we can do another deal. But we had, like, the timing has to be right. We got to have the basis that makes sense. And again, a lot of this is related to the financing. The deals we just closed on, we're not worried about, because the pricing makes sense relative to the income and the returns and the cash flow, and it's a 5 to 10 year hold, and we're not concerned about what's going to happen in the next 3 years. We've got 10 years to, you know, let the economy kind of shake itself out and to come to some, you know, price equilibrium, and to see, you know, continued growth. And we know that the asset's going to be more valuable in 5 to 10 years. You know, with a, you know, incredible high degree of certainty in 2 years. I don't know. I have no idea. So we shall see. But this is interesting, kind of just tracking, you know, where everything is right now. It's good to know. Okay, now moving on to the apartment list. We're going to talk about rent growth. We usually talk about this almost every week. Apartment list puts out a nice report, the National Rent Report, July 2022. We're not in July yet, but it's getting us ready for the next month coming up. But so, Matt, what's going on with rent growth? Rents are still growing, it sounds like?
Elevated, definitely. It's not at 2021 levels, but if we kept it at 2021 levels, that'd be insanity. But we're still well above any other year than 2020.
So we're at 17.5% was the rent growth in 2021. So now, so far, 6 months through, we're looking at 5.4%. So kind of cumulative rent growth over the last 18 months. We're looking at, you know, 20, you know, call it 24%. You know, total rent growth. That's over 18 months. That's quite a bit, and we still have some room to go. But then the question is, what we were talking about earlier, Matt, is, you know, are we seeing peak inflation, and does inflation really just kind of just drop out, or are we going to see elevated levels of inflation over a longer period of time, which I think most people think that we will, and so we'll see moderate rent growth, or, you know, are we going to get back kind of the historic norms? Because we're not too far off from where, you know, kind of a typical year, you know, is at, but I mean, it's going to be at least double, I'd say, from your typical year. But the other factor is this is, you know, compounding, you know, so it's 5% on top of the 17.5% from last year. So, you know, $1,000 rent, you know, 10%, that's $100, you know, whereas when it was, you know, $800, it was only 80. So we're talking, you know, significant increases. Nominally, the percentages mean a lot more on a nominal basis, which is what renters.
It looks like in 2021 it was around 10% in July since the beginning of the year. Now we're about 5%, but in 2018 it was around 3%. 2019 2.3. 2020
negative. You know, there was rent declines nationally. Some markets saw growth.
We could end up the year with 10% rent growth pretty easily, and I think that's just this. To summarize the rent growth for this year, I think it is going to be elevated. It's going to be a little bit more stable. I don't think it's going to be kind of hyperventilatingly high as it was in 2021.
it's where is it going to be by really August?
Yeah.
I mean, because then it really typically flatlines. I mean, even 2021, it flattened out. In typical year, you actually see some declines as not as many people are in the market for apartments. After August, everyone's already moved in. It starts getting colder. People make concessions, lower rents to kind of fill it up. That didn't really happen last year, but the bulk of the growth that's going to happen it has already started. But we've got kind of 2-3 months of growth to see what happens, and that's going to be it. So do we hit 10? Good.
Yep.
We could hit we could be at 8 or we could be at 9.
Yeah. I think the map of each market specific, national numbers are interesting, but the map of each the map of each market, and oh yeah, this is the chart that I was thinking about too when I was talking about how we're at this kind of stable new level. You see how we are. 2021 looked like it was raising up to a peak and then it kind of fell down. Right now we are approaching an elevated plateau that's still higher than any other year before it, but it's not, there's not this exciting peak and valley that we saw in 2021.
Yeah, that's a good, and that's what we've been looking for is, typically, the rent growth started kind of declining after June and July, and you were still seeing, growth, but it started the rate of growth started tapering off, whereas in 2021, it really persisted throughout July, really even into August and September. And so we were wondering, are we going to have more of a traditional seasonality of most of the rent growth kind of March through July, or is it going to extend an extra month or two, and we're going to get another month or two of really strong rent growth?
Yep.
And maybe this is showing that maybe we are, maybe we're not. I don't know.
If it's an inflection, it could be an inflection towards stability instead of instead of tipping downward. That's what this chart at least seems to indicate.
I think there's also a feeling out there from a lot of managers and owners, property managers, that all right, we've pushed things a lot and people just need a break. Mm-hmm. Maybe they can pay for it, but everybody just needs a break. Yeah. And let's kind of slow down, absorb all this growth. Because again, like we've talked about, countless times, is you still have all these rents that are much lower than the market, and you've got a lot of rents to kind of move up, and you don't need to keep moving that market rent to increase income. You can just get everybody up to market and kind of see where you are. Now, the risk is, which a lot of people ran into, is you can be behind the curve a little bit. A lot of groups were in 2020 and 2021 because they just didn't believe that that type of rent growth was going on until they looked around. They're like, oh, geez, now we're $200 under market. And so, again, that's why I think the Gray Report's a great tool and resource to people in the industry, because you can kind of stay on top of it if you don't have time to read 50 reports a week. But trying to be ahead of it. But then it's also, are you using kind of anecdotes and kind of emotion? And I feel like people are at that point. Which is probably a good thing to do as a human, but then at the same time, from a business perspective, is what can people afford and where is the market? And we saw that rents have risen, but they haven't risen anything like actual single family home prices have.
Yeah.
And a lot of other commodities, a lot of the makeup of CPI, rent, it hasn't it's beat inflation, but it's fallen behind some of those other kind of items that have increased substantially. And so, we do live in a market-based, system. That's not necessarily kind of a real free market, but, we do have markets. Yeah. And that's kind of, you don't want to be behind. You don't want to be behind the market and leave money on the table. But, how do we also be, good, member of the community and not just, drill people's lives? Yeah. And it's like, hey, we're doing great right now. Let's just focus on what we've got and look for opportunities. But, rents have already risen by quite a bit.
Yeah. And, you're talking kind of about ground level experience and specific experience. And I mentioned, maybe looking a little bit at the trees rather than the forest. And this was one of the parts of this report in talking about the changes that have happened in the last 6 months. It is really interesting. Yes, stable, elevated rent growth is a big takeaway, but I have been taking a closer look at the shorter term growth over the past 6 months that they note in this report. Las Vegas, for instance, is among the leaders for rent growth since March 2020. But it has had the lowest rent growth in the past 6 months. Markets in the Northeast, on the other hand, are really catching up in 2022. Likewise, San Jose, which had the lowest rent growth since the start of March 2020, now leads the nation in rent growth over the past 6 months. Things are happening, and they're different things. I do kind of want to emphasize this, and just for a couple seconds, and dwell on this, because for the past 2 years, it seemed like I was seeing the same cities over and over on the top rent growth, whether it's month over month or year over year. The same cities, the same hot markets, either in the Sun Belt or maybe like Boise, were over at the top of the list. Yep. And now we're seeing a little bit more. Louisville is one of the ones that have grown the most over the past 6 months. There's been a lot of northeastern markets that have grown a lot recently. So I think that there is some of those really the larger markets people are maybe returning to. Maybe they're returning to kind of the New York area, yeah. Or they're coming back kind of to the higher priced San Jose or San Francisco markets, whereas those got really hard hit early in the pandemic. So yeah. there might be not a snapback effect, but a little bit of a return.
Well, there's some catching up to do. That's for sure. And then some markets have just grown to a point where they've kind of topped out too quickly.
Yeah.
So just some of the slowest markets for rent growth. Again, to see kind of Las Vegas on the same on this list is interesting. But over since March 2020. No surprise, San Francisco, San Jose, which is near San Francisco, and then Minneapolis has just been absolutely crushed. Yeah. Houston is interesting, as being one of the slowest metros, but that's been such a popular investment market. Mm-hmm. For a lot of investors and syndicators, it just hasn't been growing nearly as much. But to your point, Matt, past 6 months, look at this list: lowest metro growth: Las Vegas, Jacksonville, Phoenix, Atlanta, yeah. Baltimore, Sacramento, Virginia Beach, Pittsburgh, Philly, Portland. Most of them, not all, but almost everything on that list was like usually in the top mm-hmm. for rent growth. So that switch at least has flipped.
We've said that we said almost exactly this thing a couple weeks ago, is how in a land where inflation pressures are increasingly being felt, prices are starting to constrain people. People are responding to high prices with reduced demand instead of just paying them. The higher price markets seem like the most vulnerable. It's not like a tall poppy syndrome. It's just like that's the first to go.
Yeah. The higher higher you climb, the further you have to fall. And this is a cool interactive map. Oh.
So my critique with this map is it goes from light blue to, which is the markets that have decreased, their rents decreased since 2020, to a dark kind of reddish orange, which is the strongest rent growth. They peak their rent growth at 40. There are plenty of markets on this list that are off the charts. There's not even a color-coded system that can record how much rent growth that has been seen in places.
Not as big of a gradient. If you're colorblind, it's a little tricky. It actually looks kind of like one of those colorblind tests that I consistently fail. But and so this is March 2020 through May 2022. So this is over a just around basically 2 year period, a little more than 2 years. Basically, since the pandemic started. But Carmel, 35% rent growth. Even Chicago. Chicago's pretty low. It's only 6% rent growth. But then over here, South Bend 18.7, and then the Florida markets have just been gone crazy.
I was looking for. I think there was
for Jacksonville, Tallahassee's 25%.
Oh, whoa.
Yeah, what is that?
There was like a Bradenton, Florida,
Bradenton,
at 52%, 52.4% rent growth. I think there is a similarly high one, like Clarksville, Tennessee, is also incredibly high.
49%.
These are off the charts.
Knoxville 47, Chattanooga only 27. Bowling Green 26, Lexington 26, Cincinnati 16. Bloomington 18, Fort Wayne 24%.
Well, Carmel and Avon, they're doing incredibly well.
Carmel 35, Show Avon, Indianapolis 20, Greenwood 29. Yeah, it's
A lot of submarkets that are doing incredibly well. I almost think it's time to start measuring it year over year instead of maybe since the beginning of the pandemic, because we're a changed landscape.
Agreed. I mean, I understand why they're doing it. It's interesting to see. I think you need to have both. I mean, it is like a kind of a notable time period of what is the difference.
Yeah.
But I don't disagree. And again, Avon 40%.
Yeah.
And again, not to kind of talk our own book, but most listeners, some are from Indy, so they know. But a lot of people haven't heard of Avon, Indiana.
Well, even people in Indianapolis don't know that doesn't come up in conversation as often.
Suburbs, it's typically your Carmels and Fishers, and the northern suburbs. Man, 40% rent growth. Since the pandemic, 20% just year over year. And again, this is what we tell people. Many investors love the Sun Belt because of all this population growth and which has led to rent growth. But the cap rates are so low, so you're not getting hardly any cash flow.
Yeah.
You can go to a market like outside of Indianapolis, go to suburban Indianapolis like Avon. You're going to get the same growth, and you're going to get a lot higher return.
Yeah.
Because you're being able to get your basis is just so much better. You're putting the same kind of debt on it. Now, that overall total return often ends up being relatively similar in the Sunbelt versus the Midwest. Maybe you get a little bit more appreciation, you get a little more cap rate compression, which involves some speculating. But in the Midwest, you just get the cash flow.
Yeah.
Because you're getting a better basis going in. You've got the good growth. It's solid employment base, solid population growth. So it just leads to a lot of cash flow. It's a different return profile that I think is more balanced between cash flow and upside, rather than I'm just going to speculate that there's going to be so much price appreciation that somebody's just going to pay me a lot more at the end of the day, which they have been. They probably will. But it's just kind of what type of risk and return profile are you looking for? And that's why the Midwest is just, for us, it's a sweet spot for all of the things we just mentioned, and that we know it.
Yeah.
We're here.
It's got my favorite thing, stability.
Much less volatile. Matt, an incredible episode of the Gray Report. Again, a lot of great research in here. I encourage everyone to subscribe to the Gray Report newsletter. You can sign up, graycapitalllc.com/newsletter, or you can go directly to the Gray Report website, where we've got all these articles and way more posted on a daily basis. You can go to just grayreport.com. Make sure you like this video, you give us a subscribe, leave a comment whether we think you're right, we're wrong. You've got a different opinion. We'd love to hear from you. And then when you subscribe, you get these videos. You get it pushed to you, so you can stay on top of the industry. And I guarantee you're going to be able to impress some folks at the next cocktail party talking about rent growth and the difference between single-family homes, multifamily, where cap rates, all that stuff that you have to get into the weeds, but try to distill it down for you in one concise piece of media. All right. We'll see you on the next week's episode of the Gray Report. Matt, thanks again.
Thank you.
All right. See you next week.